Hey guys, think about what you thought of the web in the early 90s. That was the webification, of content, digitization of content and presented on the web. What's happened now is that the fundamental innovation is this ability to own your identity, own your data, own pieces of content yourself, every single piece of content you created. It's that ownership revolution that's happening. Everything is being tokenized. There's a totally unique token representing you, tokens representing types of things. The reason that is now possible to do that is because of this invention of digital scarcity or digital ownership.
I mean, you mentioned Airbnb, Facebook, Google, Apple. I mean, they now take between 20 and 30% of all of the peer-to-peer transactions, whether it's between an artist and you and me or where we rent a house. And they're not gonna want to give up that, multi-trillion-dollar revenue source easily.
I think ultimately, and for me this links back to one of the ways in which I think about DeFi. I have a bit of a thesis that DeFi isn't about DeFi versus TradFi or centralized finance. It's ultimately about zero-fi. It's about how finance should absolutely disappear. All of those decisions about financing it or getting insurance or borrowing or lending or whatever will just sort of kind of take place in the background. We'll wander around this future global digital village, and we won't have to think about what we're doing, but because the interactions will be via the network. If all of these things went right, how big could that be? Oh my gosh, they could be that big? Okay.
The world is changing. Inspiration is everywhere. It has never been so easy to connect, share, and bring people together. We're learning from others and finding the best in ourselves. Challenging our beliefs. Sharing our vulnerability. Overcoming our fears. Transforming ourselves so we can transform the world. How far can we go?
This is London Real. I am Brian Rose. My guest today is
This is London Real. I am Brian Rose. My guest today is Richard Muirhead, the entrepreneur, speaker, technology investor, and co-founder of Fabric Ventures. You were an early adopter of Bitcoin back in 2013, and you've been at the forefront of technology innovation and investment, backing Bitstamp and advising Pantera Capital on the third largest deal in the blockchain sector. As the managing partner of Fabric Ventures, your new $130 million fund will be used to invest in, quote, the most daring and relentless entrepreneurs of the open economy on their journey to architect lasting protocols and platforms. You have stated that user-generated content drove the second wave of the web, and user-owned content will drive the third, and you frequently speak about why Web 3.0 matters and how everyone can profit from a greater understanding of the open economy. Richard, welcome to London Real.
Thank you very much for having me here.
It's great to have you here. It's nice to have a fellow Londoner in the studio because we just started getting live guests back here. We had Stani Kulichev of Aave on. I know you guys know each other. We had Anthony Trenchev of Nexo here last week, and it's nice to see people from this city talking about blockchain, crypto, DeFi, Web 3.0.
Sure.
You've been in investing technology for a long time. How is London doing in this space, would you say? How do we rank? Do we need to improve? Are we getting there? And where do we need to go, to be a big part of this whole ecosystem?
Yeah. So, I mean, tech in general or crypto specifically? Or
I'd say,
both?
Yeah, let's talk more crypto and blockchain and Web 3.0 because that's what you're specializing in now.
Yeah.
I'm curious.
Yeah, no, look, I mean, it's a good question. Actually, I was just ruminating on this a little bit earlier. A couple of people had said to me they'd seen a bit of a flippening for London. And because there was a period a couple of years ago when, despite the fact that this is clearly a kind of locus of activity around artificial intelligence and for fintech and financial services, that actually the number of projects and activity around, should we say, decentralization, Web 3, the open web, was a little bit muted. And so, but it seems now a lot of people are streaming out of fintech and looking at the way in which, AI is great, but AI needs data, and so these new platforms can handle data in a better way. It seems to be falling into place for London. I don't. Maybe it was just because these other sectors were strong, and so for the kind of the majority of people who were looking, to build a new company or join a company, it made sense to gravitate towards those. And so some of the areas that have been chasing up behind London, so Berlin, Paris, Zurich, in terms of Europe in general, folks there had more readily said, right, let's go for the thing that's truly on the frontier, where there's a bit more kind of, blue ocean to operate in, and let's go for that. But I do think London has these very fundamental strengths, and obviously the capital, proximity to VCs, lawyers, or maybe VCs and lawyers aren't needed in this space, but we will come back to that. Yeah. But I think it's really kind of shifting up a few gears now. But I mean, maybe we can talk about it more generally. I think Europe obviously has, in tech in general, has started to surpass China in terms of unicorn generation just recently, even if China was on a bit of a down. I think is clearly at least an upward trend in tech overall, and has some fundamental strengths in terms of this kind of libertarian, decentralized, open source inspired and driven movement that is the open web, and a lot of great projects, and has always operated in this slightly more distributed way. So there are, it is this, set of sovereign nations that have great academic, centers of excellence, upon which you can then, talent breeds, and people are very self-determining in building their own ventures in their own style, and have always contributed importantly to the kind of whole open source software movement individually. Historically might have ended up in a company that then gets ripped out of here and taken back to America or something, but increasingly not. And especially not in this sector, because people embrace distributed teams and remote first and so forth. And of course, that's even accelerated through the pandemic. So it's a great time, I think, for Europe on that basis. And we don't need to care. I think there's a rising tide for all of Europe, and it doesn't need to be a kind of, a competition so much between the major sort of digital city-states. What's good for London is also good for Paris, and is also good for Berlin, I think.
Yeah, it's a good observation. And, back in 2014, I think 15, I started a parallel show, not London Reel, but it was called Silicon Reel. And I just got re-excited in tech. I actually studied tech when I was an engineer before I got seduced into Wall Street. And so I had about 100 of the top founders and CEOs in tech. I had the TransferWise guys on before they made it big. I had the Stripe founder on before they got even bigger. And all these people. And the truth is, when I looked them up later on LinkedIn, they were all in the Valley, a lot of the successful ones. And there was always this pull to the US if you wanted to go bigger. And that was always frustrating about the UK and London. But now, with this Web 3.0 concept, and we can talk about that, it doesn't seem like that's going to happen. You won't necessarily have that drain to either the capital or the consumers or whatever that's happening. Now you have, like you said, that open mentality. And then you have a bunch of sovereign nations, also super creative, which we can talk about that with NFTs later as well. And maybe this is the start of a new narrative where Europe can not punch above its weight, but start punching maybe where it should be, or take its own place and bring something new to the table.
I mean, every wave. First of all, if you take the super long view, I think it's interesting, which is that there has been a bit of a supremacy of Silicon Valley, and maybe people are super aware of this, but that wasn't quite by accident, and it's not been forever. I mean, has been sort of government funding of radar, and then obviously the chips that were important for the military-industrial complex, and all these. One thing led to another in terms of the strength of the US and Silicon Valley. But that only happened kind of effectively post-war.
It's like 70s and Bell Labs.
Yeah, Bell Labs, but 40s, 50s, Fairchild Semiconductor, right. and so that's when it happened. There's great. Steve Blank writes very thoroughly about it, and I don't have it all memorized, but it's you can go and look at the history, and it makes a lot of sense in terms of the sequencing. But it's interesting if you look further back. And this is to make, it happens to be a little bit personal element to the kind of anecdote, and this is totally kind of coincidental, but someone shared with me, a cousin shared with me, a picture of my great-grandfather sitting in a car, having just done a kind of countryside jaunt outside of Adelaide, and setting, I don't know, set the record or whatever, and it was and the car was a Dion, I want to say, and it was a French car, and at the time was a highly super respected car. Gone now, I think, totally gone. But the internals of it, the mechanics of it, the engine were respected so much that they were actually being licensed to the US car manufacturers at that time. And that fact, what that made me think of is how you would never have guessed that the kind of behemoths of car production from the US that have become so dominant for a period of time were actually licensing a specialist technology from France 100 plus years ago, and how quickly the tables can turn. And then that's it's only really 100 years ago to swing one way and then maybe swing back the other. So back to this question of is this maybe an interesting time for Europe? I think with each wave of, in a particular kind of information technology, of software, you've seen it become increasingly global and democratized. The opportunity become increasingly global and democratized because it is inherent in software. Because you don't need to build the actual fabrication of for a set of silicon chips in order to be in the game. Because of software, because the great products are built from direct insight into the problems you want to solve. And so you need to be close to the problems, so that makes it global. And also because, and I saw this myself from the first time I was involved in founding a software company back in 1995, the internet made it possible to appreciate the science of startups and the science of scale-ups from anywhere in the world. Because you can just, at that point, look it up on what was called Muscat, or then Alta Vista or whatever. But now you could Google it up and get your result, and you can learn obviously pretty much everything. It's right there sitting on your sofa. And so I think that all of that has pushed it sort of around the globe, and we see that now accelerating with Web3 and the open web. Why is it accelerating with the open web? Let's put aside the question of COVID and remote first, which clearly is a factor also, because it's because a couple of things. One, there was a shift towards you could argue, I guess, the supremacy of open source software that at least I coincided first in the 90s. And open source software had started as this kind of almost romantic movement of it's just from a point of principle wrong that this should be owned in a proprietary way. And so it shifted from that to, okay, well, if we can distribute databases over the internet and have them used by millions of people, maybe we can actually create a business model around that. And so my former partners who co-founded MySQL, still arguably one of the world's most sort of popular databases, they exploited that. And then, but that open source, was incredibly powerful. Those business models are a little hard to make work. And so we came into the age of what we could think of as Web 2, the second wave of the web, where companies, large companies, the ones we're familiar with, Facebook, Airbnb, Google, Amazon, and so forth, take those open source projects, build these incredible cloud-based, services upon which our kind of lives increasingly rely, and sort of capture the software that way, and probably sponsor a bunch of people to augment those projects, and then extract from us either through that margin of opportunity that Bezos has, or obviously through the advertising that many of the other platforms use. That's how it gets monetized. And we'll come into maybe what the kind of issue is, but open source, the principle of it being free for anyone to use is something that actually was stifled by that Web 2 movement. Right. In Web 3, it is truly open source, and not just the open source software, but the open source execution of that software, and open source data residing in those networks that are being built out there. And the reason that is now possible to do that is because of this invention of digital scarcity or digital ownership. The fact that you can build these networks and have the network understand the identity of an individual have the network understand the identity of another machine on the network, have the network have baked into it incentives that are native to it to allow for the coordination of its operation. And that creates a business model, which means you can shun the previous ones. And actually a lot of the things that the inherent capabilities of open source movement, the fact that it's sort of, inspectable openly by many different people, and the fact that it's forkable is incredibly valuable because it creates a kind of productive tension for the networks to be continuously innovative, and importantly, innovative in the interests of their users.
Right.
Because otherwise the users are going to pull the ripcord and go somewhere else. And so that's kind of two different things together: the open source movement and this shift now to Web3, which creates an opportunity for Europe, maybe even inspired by its kind of libertarian counterculture that in turn, sadly, perhaps was inspired by hundreds of years of nation state sort of battling, and obviously the last century in particular fighting kind of tyrannical forces on both the left and the right end of the spectrum. So I think, it's a great opportunity for Europe.
And the glaring examples of like Web 2.0 versus 3.0, Web 2.0, Facebook, for example, everyone uses it. It adds a lot of utility to everyone's lives, but the winners of that are the equity holders and the Zuckerbergs of Facebook. And maybe the other example of Web 3.0 might be Bitcoin, for example, or something on a blockchain where it's distributed. Everyone has equity via the tokens, and its value goes up when the network expands. And like you said, if people aren't happy with it, it can always hard fork and go somewhere else. Are those like two examples for people to start to get their heads around? But then also you don't want to limit yourself to those because Web 3.0 means much more than Bitcoin.
Indeed. And like, so definitely, I mean, you don't want to limit yourself even just to poor old Facebook as well. Although, so you could take Twitter, but I think we've seen Twitter start to really, make moves because of the inclination of Jack Dorsey to embrace this shift towards decentralization, whether it be use of NFTs or, maybe looking at incentive structures outside of advertising and so forth. But, LinkedIn, I think it's fascinating to see that Microsoft might actually already be acknowledging that LinkedIn is doomed effectively if the identity of individuals on it and their resume are owned by Microsoft. It does not seem conceivable that in the future, if you are from your kind of nursing home, so for your nursery to your nursing home, you're allowing for your life to be captured in digital form in a resume, that you don't own the identity that's been the password and the access and the control of that yourself, and rather it's owned by someone over in kind of Redmond. It doesn't seem like that can possibly be the future. And you're going to need to do that if your life is going to be conducted so much online, if you're going to get your job, your next 5 jobs by, some organization out there recognizing anonymously your kind of potential and sending you information and requesting whether you want to kind of be involved. That kind of deep job market, that's what's going to happen. And so I think that's going to, LinkedIn's going to transform. And so there are other, and I think marketplaces like Airbnb. I mean, it seems you touched upon the topic of users, individuals having equity in these projects. All of the users, individuals, but especially the ones who are the first ones to get involved. Those first people who put their properties on Airbnb, they've had just a tiny slice of Airbnb. They've done very well out of it. Thank you very much. So that's an example of how it can be done differently. And if you piece it together, the sort of secret superpower, or the superpower of Web3 is its ability to coordinate effectively strangers on a network to do really sophisticated things together from the point at which there's just a few of them, solve the cold start problem, through the scaling of it, and then actually then to have built through that a community that leads to its defensibility. So it's and that whether if you don't maintain the interests, as we've touched on already, of the users in that community, you won't have a good community and it won't be defensible anymore.
Yeah, it's fascinating to watch it develop, and I'd love to get your thoughts what it's like to watch this space for the last couple of years and see DeFi summer of last year and all those incredible things happening. Right. I mean, you mentioned Airbnb, Facebook, Google, Apple. I mean, they now take between 20 and 30% of all of the peer-to-peer transactions, whether it's between artists and you and me or where we rent a house. And they're not going to want to give up that, multi-trillion-dollar revenue source easily. And so this transition from 2.0 to 3.0, I guess, will be bumpy inherently. And we are used to this whole world of equity owners, venture cap. I even asked Danny a question: is venture cap by definition Web 2.0? And this is probably the hard question.
I'd love to hear what he said.
Yeah, because, and I'm curious to ask you that because, you're out there creating value, investing in people, fostering these companies, but ultimately, you want a return for your investors. You want the equity investors to win. But now you're in a Web 3.0 space where also you win if the network wins.
Yeah.
And so you have to walk the line, as Johnny Cash would say. So how do you walk the line? And is VC inherently 2.0? And can you shake that off? Stanley wasn't sure. He emailed all the VCs when he was in Helsinki and they ignored him. And then he went, obviously, the route of the tokenization. And, that worked out for him. But there's probably 1,000 other companies where it didn't.
Yeah, no, exactly, and that's fine also because that's intrinsic to the kind of super early stage projects. They don't all work out, and we knew of Stanley before the name changed from Ethlen to Aave, but maybe before he'd done his tokenization and the initial raise he did back in 2017 or whatever. He's not running. He's founded and now part of the governance of one of the outstanding projects across Europe, and maybe we'll touch upon that. So first off, the most outstanding returns from a financial backer perspective or financial contributor, to maybe put it in half Web3 parlance. It's much less to do with titles, and it's more about participation and contribution. They come from where these projects where you get network effects. And the exciting thing about this space is it's kind of like, this is a software platform optimized to solve the cold start problem, to get the network effects going and then keep them going in a positive way. So that's super exciting. But not just that, but you get layers of network effects. You get buyers, sellers, liquidity providers, validators, and financial backers who are all kind of benefiting from an intermeshing set of kind of network effects. I can't do the maths of exactly how those play out in every case, but people are, that's becoming a new science. But there are different stages to getting them going, and there is a stage when you're trying to get it through, bootstrapping, where some capital is kind of useful. You need to spin up some validators, you need to hire some people and whatever. And so there is a role for some capital. So is it venture capital as we knew it? Well, I think you need to be comfortable with some very different aspects of these projects. You need to understand that you might be investing in a company into its equity when there's just a handful of people and they know what they're going to build. But actually, the equity you have is never going to intrinsically have any value at all. It's just going to give you some rights over the tokens that will get created in the future that will represent your piece of the digital real estate that is the network that gets built. And other people will have a share of that. And actually, inherently importantly, that's a pie that needs to be divided much more broadly than a venture capitalist might normally think about it, where, let's take, for example, you want 20-25% ownership out of the gates. So you end up at the post-IPO at 10 to 15%, and then and your biggest result is one that works for your fund economics.
Right, that's what you might typically look for in a VC.
That's the typical thing.
You take 25 in the beginning. By the time you get to IPO, you have 10 or 15%.
Yeah.
Hopefully, it's a deca unicorn, and you're happy.
You're extremely happy.
Right. But that won't happen necessarily in this blockchain space.
You're not going to have that ownership.
Right.
But at the moment, at least, there are some returns, some multiples that have been both faster and higher than you would typically see in venture, or generally see on average, generally see. But also, look, and it's so hard to say because we're very early in this game, and there's a lot of new projects, and there's a lot of, this frontiers being pushed back. If you are, if you're up to speed with what's going on, and you're connected and you're valued as a financial backer or contributor who isn't just writing a check, but actually can help you connect with talent, connect with exchanges, think about the token economics that you're building and the specialized business model here, can do all of those things, maybe run some validators physically, give feedback, help bootstrap the kind of user side, whatever it is you might be able to do, roll your sleeves up and contribute. If you can do that, then I think there's great projects to be involved in, but also there's a different nature to these projects. You're not building a company, you're building a network, and you're building a network that is probably going to be intermeshing with a lot of other networks. Because I talked about the superpower kind of open web being, and Web3 if you want to call it that, being, its ability to solve the cold start problem and then keep network effects going in a kind of benign way. Another superpower in this space is what you might think of as composability. So the fact that you can have networks running, say containing credit worthiness of an individual, and another one that's running that gives you some information about availability of collateral to put against which you could make a loan, and then those could be live running services. Yeah. So they're not just blueprints for software you could build. They actually are not even just services that are empty shells that don't have data and users and information behind them, but they actually be both live running services, and you can compose them together into another service. And so the reason I say that is that when you build something, it gets intermeshed like that with other services, which gives us a kind of a support that you wouldn't have had before. And also it's a community you end up building. And so take Bitcoin, nobody arguably has ever known who Satoshi Nakamoto is. And I'm sure they did that by design, understanding that would help this be successful. And so that demonstrates that you can have a founder be present even in a pseudonymous way only for a couple of 3 years and then vanish, and still the project can be super valuable. So venture capitalists, normally one of the biggest risks you have is co-founder risk, and do the co-founder stick around? So this is going to fly directly in the face of that. But the same is also true of other projects. You can create enough momentum in the flywheel around the community and the talent and the software and the network and whatever, that it has its own life. That would be true of Stanny with Aave as well. And so going back, so what are we kind of analyzing? Is there a room for venture capital? Yes, there is, because you can be a financial backer if you're prepared to understand how this new opportunity works. But it also looks quite different from venture capital in those different ways. And so you're going to be rethinking fund composition and economics and the profile of everything quite fundamentally.
Right. Even your behavior and what you call yourself and all that.
Sure.
I mean, you have to innovate as a VC, and I'm guessing a bunch of your peers, which I think I had them all on the Silicon Reel back in the day, some of them aren't as adept maybe to change because maybe they've been doing this for 30 years and they're used to being the gatekeeper.
Well, I'm not going to pretend that I'm 29 anymore, and although we definitely, I'd say we're probably, can I say that even? It might be sort of ageist, but fairly openly biased towards teams who are of that age. I mean, there's a plasticity of the synapses or whatever that tends to exist there that ossifies, if I'm not mixing my materials, metaphors or whatever, over time. So it is possible there's some venture capitalists that are not positioned to really change their perspective on things. But all frankly, without sort of putting them in that kind of particular bucket, don't have to. Web 2 is still going strong. There's still a lot of the world to be eaten by software. But what's happening now is that, and this is where we like to think of it, that software, we've talked about a little different ways of thinking about open web, but one other way of thinking about it is this is a new wave of software. It's software that now can make and keep financial commitments. And that seems like a pretty kind of powerful thing for it to be able to do. But the other wave is still going, and this new wave is, even though we've got a couple of trillion of kind of network capitalization out there, it's like so baby steps at this point in time. and there'll be some baby trips and and so forth, and people will probably put their leg out and try and trip it up. Still, they are, but so it's super early.
Right. And so if someone's watching this right now and they're a founder, they've started a company that's Web 3.0 based and blockchain based or crypto asset based, they're probably thinking, okay, I can call up Richard and work on an equity investment, or I can go down the token route. I mean, there's pluses and minuses to both. I mean, I was even talking to Dan Muirhead at Pantera, and he's like, we almost arbed the situation. Sometimes there's more opportunities in tokens. Sometimes the more opportunity to VCs. We still see lots of VC investment happening when clearly people could raise with tokens. So there's still a lot of value to be added by the VC. If someone's watching this right now that was like Stanny back in Finland in 2017, and say he did have access to you, how do you advise them as to which to choose?
Well, so pretty early on, we said a kind of a core competence for us has got to be that we're agnostic as to what the instrument is, because what we feel is that there's, that is one of the key elements of this frontier of innovation, is coming up with what those instruments should look like. So it would be silly, I would say, for us to say, this is the right thing for this particular business model is going to be equity, or the right thing is it going to be this flavor of token or this combination of different tokens. That's what the entrepreneurs trying to decide. So we would cut and slice and dice things in a different way. So we have a early stage venture fund, and north of 100 million euros, and we although we've got a pocket for super early stage investments, primarily we're looking to get deeply involved in up to around about 30 different projects from that.
Okay, so if I do the math, I can figure out you're looking to invest $2 to $5 million.
Yeah, and so there may only be one or two initially, and then there's deeper in the ones that are kind of playing out, and you do we have follow-on strategy to it, reserves and that. But we don't differentiate in there between ones that may end up being equity based. So we're fortunate enough to have invested in Sorare, which football cards, fantasy football, and they're doing tremendously well. Just the biggest venture round ever, 680 million.
680 million, right? Yeah, it's multi-billion-dollar valuation.
Yeah,
right?
But that's an equity play at this point in time, which is going to then build. There's now a move to see what you can do with that data, and they're going deep in tackling the beautiful game. You may well look at other sports in the future, but I think they've got their hands pretty full with the beautiful game. And
just football or soccer if you're in America.
Yeah, exactly.
Right, okay.
Or Aussie rules, we would probably call it if we were. We'd argue if we were back in Australia. But anyway, it's that's equity, and that's fine. We don't differentiate. That's the right call. But you got something else. We just announced an investment in Angle Protocol, which is taking the next step in thinking about how to build synthetic assets, in the digital realm, using that cryptographic scarcity, and in particular stablecoins, and in particular standing with the euro,
right.
And so that's a token play, and so for us we don't distinguish it, but we're early stage, and whichever direction it goes, we do. And so that means we're also very happy going into equity that becomes tokens. And if someone has already got to tokens early, fine. But we don't want to mandate that, because we want to get in at the point at which they're probably still working that out, and they might want to work with us on that point. Now, later stage, it becomes, probabilistically speaking, more likely a token is in place. But it's more about being later stage, and that's the distinction. There's another way of thinking about it, which is there are opportunities that are not venture. There are opportunities that are kind of more hedge fund-like or crossover fund-like in nature, where you can, make an investment, provide liquidity to a network, and earn yield. So-called sort of yield farming, where you can lend out and get your crypto and get an interest rate on them. This takes us into some of the parameters, the interesting components of decentralized finance, and so that's distinct in our mind, and we'd think of that as not Fabric Ventures but Fabric Capital, But so if that makes sense, is how we kind of navigate some of those distinctions, and something that's playing out. And of course, our job is to have funds that make primarily most sense from the perspective of the entrepreneurs. Those are our number one customers. and our second number one customers being obviously the investors that we have that make sense for them in terms of where they want to allocate their capital.
Okay, so you have separate funds for that, a capital fund and investment fund?
Well, strictly speaking, we have one venture fund,
okay.
But we have in mind where we're going to go with the other elements, and we have a later stage venture strategy, and then I have in mind, but watch the space basically. Yeah.
Okay, and in the investment you announced today, I think a total of $5 million in Angle, right? Was that a public token before that? Like, did anybody have bought that yesterday?
No, there's nothing. I mean, it's there's some
token
test networks out, but it's.
But that was via token, not equity, for example.
No, that's via equity, subject to future mapping to tokens.
Okay. Understood.
Yeah, so there'll be, and that mapping is that's as defined and through trust and governance between, you're basically seeking as much alignment as possible with the founders. That's, you want to be helping them build the project, and so that's what you seek. Upside, downside, that you're kind of aligned with them, and look to be, and so they have equity, and then when tokens come around, they'll have some piece of the tokens, but they will also be looking to put the tokens into the hands of lots of different other stakeholders, depending on the project, to make the project successful. It's like the power of option schemes and equity that we've seen in Silicon Valley over the decades, but now on steroids. Like you can to allocate it to lots of different participants, including the users, the buyers, the sellers. Yeah.
Yeah. It's incredible to watch, and I want to talk about maybe quickly DeFi Summer and how that all played out. Burning question is, and maybe you don't have to explain the example with Angle, but how does that process start to where, back up the investment to say 3 months previous or 6 months previous, or maybe not that one, maybe a smaller investment. But how would that process start? Like, do you get an email? Do you get a warm intro? What opens your eyes? What doesn't open your eyes? When do you say to someone, keep working, come back and see me in 6 months? Like, I think everybody would be curious, what goes through your brain, and how do you try to identify the people you want to work with?
Yeah, I mean, at the end of the day, to be frank, you battle hard to do lots of work so that when it gets to that point, you have to do no work. By which I mean to do the work so that the kind of the brand that you have as a firm and as an individual means that when you're not in the room, as the saying goes, that folks go, hey, they would be worth working with, and so somebody asks for an introduction, because there's by definition just a lot of activity, a lot of different projects. That's not to say you don't continue to do the work of looking at them and scouring through them and doing that outreach, because that's part of the work you need to do to show that you can be bothered, but that you understand that by doing that work, you learn what's going on out there, and therefore you would be a good partner. You can't skimp or on the work or shortcut the work. But ultimately, by doing the work, you end up hopefully being introduced to the right people and selected, often through a kind of a warm intro, not through an old boys network or whatever, but somebody anywhere within the kind of portfolio or your close community who helps you with discerning the signal from the noise, because you trust them because of their view of the problem to be solved or the technology used or whatever it is. And so, whether it be somebody who's running a course on computer science and cryptography who has these people in their class and he thinks that they're just like stellar, or it's somebody who's running meetups around the space and knows who turns up and who doesn't turn up, and gets into a kind of pineapple juice conversation with them or whatever. It could be any of those things that lead to the intro, and then you really kick in again to, I think, a very human process of kind of pattern recognition. But it's not you can dissect it a little bit. It's, and I think it's commonplace from venture really. It's folks who are daring and relentless in a kind of really kind of walk the line, both confident but humble way, who understand that you can make massive markets as well as tear down existing big ones, and who are kind of good enough at saying no, that they can start with some seemingly trivial sort of entry point to the market and toy-like product even, and then think through okay, how that might scale and what the ultimately in this case maybe either a revenue-based or a token economics-based business model might be. And another element, and we can come up with more and more, but have a bit of a charisma and energy and energizing capability that you think that they will be able to hire people even better than themselves for the next roll down. And so if you kind of see and feel that pattern, and really, I said it before, I will say it again, often people who are some combination of naive and irreverent enough and foolish enough to try all of the this kind of endeavor, it makes sense. And actually, people who have sometimes too much experience of a space and think it should work in a certain way, it's hard for them to get their heads around, really shaking it up.
They see too many problems.
Yeah, they see too many problems. We're always thinking of the thing, if all of these things went right, how big could that be? Oh my gosh, they could be that big. Okay.
Right. And so you need a little bit of a cult-like figure to get the ball rolling and get critical mass and inspire people. But then you quickly, in Web 3.0, want that to be dissolved. I mean, we see this kind of with Charles Hoskinson, Cardano. He is probably the single biggest spokesman and regular spokesman in this DeFi space. And yet he admits, although some people might disagree, he'll be on the show in a couple of weeks, that he's trying to get himself out of this thing. It will become something that's nothing to do with him now. But in some ways now, he's useful to that extent. And then we can look at Vitalik and we can look at Gavin, who you've invested with at Polkadot, and see how they all attack that problem. But you kind of need a little bit of that to start, right?
Well, for sure. You kind of got to start somewhere. That you do have a cold start problem. You've got the kind of empty room or the one person in a room problem often. So inevitably that's the case. And I think it's foolish or incorrect to argue that there aren't stages of the governance and execution of a project where the ability to make centralized decisions and command and control and move rapidly in that sense, the value of that does not outweigh the consensus that you might get from community and decentralized based, decision making. Decision making is tough, even for individuals on their own, let alone, and small groups and families, yeah. But two things. One, ultimately, there is value in having community-based decision making, and that ensures that we can have an architecture, have networks that truly can't be evil in nature. Move away from the mantra that Google dropped 2 years ago, whatever it was, don't be evil. Right. You need, that's inherent in the stack you need. It's not just the decentralized computing nodes at the bottom. It goes all the way up to the decentralized decision making at the top. And at that point, that's necessary. And it is important that whoever is kicking it off the ground, in the project in the first instance, generates enough transparency, enough trust at that point in time that they will make that transition. Because otherwise you won't attract at the beginning the people who believe in that ultimate vision. And yet it doesn't need to be done. And it's non-trivial, and there are phases of decentralization of different parts of the stack, hardware, software, and governance and so forth, and even layers of governance. And if you misstep and people detect that you're either not decentralized enough or not as decentralized as you said you were, that's not bad, not good, or that you're not going there quickly enough, people will choose to, in decentralized autonomous organization speak, rage quit from the situation,
rage quit means everyone leaves the protocol.
Well, so it's a little bit like it's an individual's ability to hard fork their value from a DAO, and it was kind of put in place a little bit by Amin Soleimani, who put together Moloch DAO, and it's saying, like, at any point in time you have the tension of each individual being able to rage quit and take the value they have at that point in time, time with them. It's like kind of like, I got my parachute, let me go, and it's kind of a little bit similar to the productive tension you get from.
To continue watching the rest of the episode for free, visit our website londonreal.tv or click the link in the description below.